As ordinary retail investors, we typically review the U.S. stock market performance of 2025 and prepare for 2026 at this time every year. Today, I'd like to share some personal perspectives. To be honest, 2025 was quite a favorable year for investors. The S&P 500 index rose 16% for the full year, closing at 6,145 points at year-end. On the first trading day of 2026, the S&P 500 edged up slightly to close firmly above the 6,900 mark. However, most of the Magnificent Seven tech stocks declined, with some falling for 7 consecutive sessions. Investors should remain vigilant about valuation bubbles in AI-related stocks and beware of significant pullbacks from elevated price levels. At the same time, opportunities in other thematic stocks deserve attention. The current market tranquility often masks underlying risks. The VIX index currently hovers around 14, situated in the lower range of the past 5 years. Historical evidence suggests that when markets exhibit excessive calm while indexes trade at elevated levels, heightened volatility often follows. It's worth noting that market expectations for Federal Reserve rate cuts in 2026 have become overly optimistic, almost fully pricing in 4 rate reductions for the year. The Fed's actual policy trajectory has historically proven more cautious than market expectations, and this expectation gap could trigger significant market volatility. 2 key dates to watch in January. January 13th, J.P. Morgan Chase will kick off the financial sector earnings season with its fourth quarter results. Investors should closely monitor bank executives' commentary on loan quality, economic outlook assessments, and first quarter guidance. As the core of the financial system, bank stocks often reflect the overall health of the economy, and any negative signals could trigger chain reactions across markets. January 28th, the Federal Reserve will announce its January FOMC meeting decision. Historical data shows that January FOMC meetings frequently serve as catalysts for annual market volatility. Should the Fed fail to deliver the expected 25 basis point rate cut or adopt a cautious tone regarding future easing, highly valued sectors would likely face immediate pressure. The development prospects of AI technology are undoubtedly promising, but market enthusiasm for AI-related stocks has driven valuations to unsustainable levels. Currently, leading AI concept stocks trade at an average price-to-earnings ratio exceeding 50x, with some pure-play concepts lacking actual profitability to justify their valuations. Industry insiders reveal many companies are reassessing the actual return on investment for AI projects. Not every company requires its own large language model, and many initiatives offer limited business value beyond trend chasing. When markets shift from concept speculation back to fundamentals, highly valued AI stocks could face substantial correction pressures. While remaining vigilant about high valuation risks, several undervalued opportunities merit consideration. Regional bank stocks. Compared to major money center banks, regional banks focused on small and medium enterprise lending often demonstrate more robust fundamentals, with dividend yields typically ranging between 4 to 5%, significantly higher than the broader market average. Select regional banks with healthy balance sheets and strong loan quality deserve investor attention. Traditional energy companies in energy transition. Markets have disproportionately focused on pure renewable energy companies while overlooking the critical role major oil companies play in the energy transition. Several petroleum giants are beginning to generate tangible returns from investments in hydrogen energy and carbon capture technologies, yet their valuations remain at historic lows. Following 2025's generous returns, many retail investors tend to overlook risks. Historical data reveals that after the S&P 500 has posted gains exceeding 10% for 3 consecutive years, the average return the following year is merely 4.6%, with more than 50% probability of decline. Investors should prioritize position management now. Failing to adjust holdings at these elevated levels could see hard-earned profits significantly eroded during major corrections. Recommended strategies include reducing overall equity allocation while increasing cash positions, trimming highly valued AI concept stocks, and diversifying into reasonably valued sectors, maintaining defensive assets like high-dividend stocks and consumer staples, and reserving sufficient capital to capitalize on potential market overreactions. The investment adage, Be fearful when others are greedy, and greedy when others are fearful, remains profoundly relevant. Current market sentiment indicators show widespread investor optimism, a classic signal warranting heightened caution. January 2026 may prove pivotal for market direction. Investors would be wise to reduce trading frequency, observe more, and act less. While maintaining vigilance, preparation for potential market mispricing of quality assets is equally important. The calm before the storm is often fleeting, yet prepared investors consistently find rainbows after the downpour. Anticipating risks in advance and maintaining rationality are essential for achieving long-term stable returns in the equity markets.